Default risk in bond pricing has a lot to do with the credit rating agencies. So there are really three credit rating agencies: Moody's, Investor Service, Standard & Poor's, and Fitch. The highest rating is AAA. Some rating agencies are different than each other in how they exactly denote that, whether it's three capital A's, or a capital A and a couple small A's. They also have B's and C's and so on. Investment grade bonds are rated B, Baa. Depends on which of these three firms you're dealing with on what exact ratings they have. But basically, their highest rating, AAA, all the way down to junk bonds or even non-rated bonds. So the determinants of bond safety are pretty straightforward. We covered these in corporate finance also. Coverage ratios, in other words, can you make sure you pay your debt? Leverage ratios, how much debt are you in? How leveraged is your firm? The debt to equity ratio, how much debt do you have versus how much equity in the firm do you have? Liquidity ratios, we want to be able to cover our debt easily with cash. We want to be able to easily pay our covenants, our loan payments. Profitability ratios, we want to look at how profitable you are as an organization. And then cash flow to debt ratio. Cash is, as you know, without question, cash is king. And if you want to pay a bill, you're going to have cash. So they look at liquidity, cash flow, and so on. But they also look at profitability and a few other factors to determine if you're going to default or not. There's some examples here of financial ratios and default risk by rating and by class. The AAA is the gold standard of credit. If you have AAA credit, you are not going to default on your loans. There's no way to have AAA credit if they think there's any chance that you're going to default. As you move towards CCC and even junk, the chances of default get much, much higher. In some cases, it is almost a certainty you will default, and people will still invest in that as speculation over the short term, even though they know over the long term you will likely default. So you can look at a couple of different things here. This is EBIT, interest coverage multiple, the EBITDA interest coverage multiple, funds from operations divided by total debt, free operating cash flow divided by total debt divided by EBITDA multiple, return on capital, so on. You can read all these terms, and you can see that the terms just go down as you go. So EBIT, interest coverage multiple. So you could cover your interest when AAA 23 times. In a B, you can only cover it 1.2 times, and in CCC, you can't cover it even once. And so that's a worrisome thing. The return on capital at 27% AAA, you're getting a great return on your money. In CCC down here is 3.2% return on capital. That's not a very good profit margin. You can also look at other things as total debt divided by total debt and equity, or your debt to equity ratio is much less in AAA than it is in CCC, which is very levered to the balance sheet. So you can look at the different numbers and where individual firms fall. They're going to be in somewhere around these ratios each when they start to rate them as a credit risk. Unless you're in the credit risk rating business, you're just going to use the letter grades that they have. And so you're going to say, is it AAA, is it AA? That's a very high grade credit. And as you start to go down the spectrum of lower credit risks, you'll get higher returns, but you have the chance of not getting your money back. So credit rating agencies play a very big role in the market. There's really only three of them. There are an oligopoly. They're almost a monopoly as they move together quite closely. So credit rating agencies are very, very important with regard to borrowing money and having your credit rated at an advantageous interest rate. So credit rating agencies, as you know, in the financial crisis were a problem because they rated things that were not AAA as AAA. And of course, that was a problem because people would invest in things that they thought were safe that actually weren't. Okay, so we've talked about that a little bit. Let's keep talking about default risks and some of the bond indentures and different aspects of bonds and how they affect risk.